What's up, traders? What is the probability that SPY, the S&P 500 index ETF, will reach 500 before the end of 2021? Now, this is not an analysis saying that it is or is not. I'm just asking the question, what's the likelihood? What are the chances that it actually gets there? And we're going to use option data to answer that question. At the end of this, you'll hopefully have learned something you can use in assessing the probabilities of something happening, as well as using your option trading. And you're also going to learn something about the different kinds of options and which ones may be better to express an idea. So, I got a little presentation for it. Let's go through it. So, what is the probability? And we're going to use option delta to assess the probability of stock movement. So today on social media, my Discord, I asked the room a question and got a lot of good responses back. A lot of people made their guesses and opinions fine, but I was looking for someone to actually dig into the statistics centered around the options chain of SPY. Now, how we can do this is we can look at the delta. Now, the delta value of any given option works as a proxy for what the market is predicting the chances of that option expiring in the money will be. Now, some platforms like Thinkorswim and Tastyworks have an additional probability. They have a probability in the money calculation, and they're going to be within a few percentage points. But if we don't have the probability ITM, if we look at the delta of any given option that we may select, that we can use for our probability of this option expiring in the money. So if we're going to look at this, the answer to my question was about 5%. There's about a 5% chance of SPY getting or closing, above 500 by December 31st, 2021. Doesn't mean that it is going to touch it and come away, but this is just the probability of it closing above that. Could get beyond it. Who knows? But that's what we can tell by looking at delta. So, how accurate is this measurement? It's one thing to have someone tell you that's the probability, but can we actually back this up? Well, I wanted to test this and find out and show you the results. So I'm going to use everybody's favorite, Tesla. I'm going to use the Think Back feature in Thinkorswim, and we're going to do two different options. We're going to choose an at the money strike, which is usually about 50 delta, and then we're going to try to be consistent with an out of the money strike of about 30 delta. I was going to go after the split to keep things all nice and normal. So from September the 4th, 2020 through July the 30th, 2021, that is going to be our date range. I'm going to take these weekly options. Now, I don't like weekly options, but everyone seems to love them. And hopefully, at the end of this, you can get a little better playing your weekly options if you insist upon it. It also helps me find enough data to make this thing worthwhile. So, what I did was in Think Back, I went through every week on Friday and grabbed the at the money option out the money option, and then the out of the money option. And then we basically went through to the next Friday expiration and saw what the P&L was, saw what the closing price was. Bear in mind, as a disclaimer, this is just simulated data. In other words, doesn't necessarily mean that you would have gotten these fills in the actual market, but it still gives us a good idea of the statistics to validate, is this something we can use? So what were the results? Well, we did 47 weeks, which was 94 trades, one of each. The delta, the average delta, because sometimes it's going to be different depending on the option. The average was about 53.05 delta on the at the money options, which gives us an implied probability of it expiring in the money at about 53%. The out of the money average delta was 30.39, which gives us an implied chance of expiring in the money of 30.39. Well, how did it actually turn out at the end of all these trades? Well, the actual expirations at the money expired 53.19% of the time in the money. That's really, really close. The out of the money expired also very close, 29.79%. We got very, very close to what would have been expected given all of these trades together. And the law of large numbers says that if we just took more, we should get even closer. It should be very accurate. That's pretty cool, actually, that the delta tells us with some pretty good accuracy if you take enough trades, this will be what you can expect. So, which options were actually better between the at the money and the out of the money? Well, of course, the probability was that the option would expire in the money, but it doesn't necessarily guarantee we're going to make money because remember, we're paying a premium for these options. So the win rate for at the money was only 34%. So we only made money on 34% of those trades, which is a lot less than the 53% of them that actually expired in the money because we pay such a high premium for an at the money option. We had to clear that to make money. The out of the money, well, it also performed less than what we would expect. In other words, we made money on 27.66% of these trades, which is less than the 30.39 that they actually expired in the money. But again, we're paying a premium for that. What was our actual P&L? Now, this is Tesla, so it was very bullish and we're buying calls. So yes, we made money buying the at the money calls. But if we actually look at the out of the money calls, which we're taking two of them each time because the cost of an out of the money option is going to be roughly half as much as the at the money. So if we adjust the risk, the P&L for the whole back test was 18 grand, a little over 18 grand, almost double the profit that we made from the at the money. That's a big difference in taking the out of the money, even though our win rate was significantly less. At the money options, you're going to win more. Yes. Out of the money, you're going to have fewer wins, but the actual P&L comes out you made more money on the out of the money choices. So what do we find out? Well, Delta's pretty accurate in terms of predicting if an option will expire in the money. We can use it. We can have that in our head as an assumption. Every trade is going to be different, but we can look at that and say, okay, I know what this delta actually means in terms of my probability. And it actually kind of lends credence to the efficient market hypothesis because remember, this delta value is being derived from an equation that gives options the prices they have. So the market is actually pricing these pretty accurately to what ends up happening. And the most important takeaway that I want everyone that trades options to think about is how the at the money options, which most people tend to, I notice, want to take because you have a little bit higher probability of wins, they actually underperform out of the money options. And the reason for this is because at the money options are going to have higher risk. You have to pay more for them. They have higher risk going up front. And the out of the money options are going to have lower risk. They're typically cheaper. But what happens when you actually get a win on the out of the money options is you get that gamma acceleration as price comes closer and closer to your strike. You get a much better reward to risk ratio with out of the money options. So if you want, you can pause the video and see all the crazy math and spreadsheet that I did here to come up with this. But I hope that this can help people understand exactly what the probability of a stock or an index or whatever is getting to a certain level using the options delta. It's a really cool trick that you can answer this question for yourself. And also, if you are trading options, you need to consider the performance of out of the money option versus at the money option. Sometimes it can be a personal preference depending on your strategy, but go through and do a back test every time you take a trade, an at the money trade, and you make some money. Go look at an out of the money option that you could have taken and see how much better on a risk adjusted basis that would have been. In other words, if you spent $200 on an at the money option, or if you went out of the money several strikes and you had two contracts at 100, see if your P&L wouldn't have been that much better. Give it a try. See for yourself. Trade wisely, and we'll see you in the next videos.